Hey guys, what is up? George here from the Millionaire Project. First of all, I want to wish you all a happy new year. I kind of just wanted to make this little video here and kind of give you guys a little 2022 market outlook. And then I've also put together a list of some names that we're going to be looking at here that we believe are going to have a promising future this year. So before we get into all that, let's kind of just look where we're at in the market right now. So 2022 has sort of been off to a pretty rough start, for lack of a better word. It's just been very volatile. Usually we have a very strong start to the year following the Santa Claus rally and the January boom effect, but we really just haven't gotten that. So looking back, you could see that 2021 was just a historical year for many names, tech in particular, companies like Apple and Amazon, just showing some tremendous and nonstop growth. And any experienced individual in the market is going to tell you that eventually these massive runs are going to come to an end, or at least have some sort of a slowdown. People are just going to start taking their profits and start putting it into other names. So these companies that have had these massive runs like Apple and Amazon, people know, experienced investors, traders, analysts, they know that these are overvalued positions now. So they're going to start sizing out of them and putting their capital into new sectors and underperforming names. This is just how markets rotate. This is just how it's been. So currently, looking at the past month or so, investors are just sort of uncertain about where we stand as a market whole. We just mentioned we had money start rotating from tech into underperforming names as well as many value stocks. And this is all due to the simple fact that investors, traders, analysts, they all know these names are starting to become overvalued. Like we just said, this is just how markets work. They rotate from one sector to another and you have to capitalize on each. Another factor is the Fed's policy change regarding raising interest rates and cutting back on their bond buyback program. So tapering, we talked about this in previous video. This also raises concerns about inflation and just how much higher it can go in the coming year. This is a pretty big issue. Investors they want to make sure that the Fed is in correspondence with what they're telling us. To top everything off, you still have to remember, investors do have the thought of COVID and the Omicron variant in the back of their heads. Although this could potentially be a plus for the market, and I'm going to get into this a little bit later, but for the gist of it, in recent weeks, we've seen a huge spike in Omicron cases. They've been hitting record numbers across the globe. However, one key thing to note is that the deaths are not nearly as high as they were. So looking back at historically, we could see, we can even go all the way back to the Spanish flu, but just keeping it, a little bit more recent pandemics, we could see that when this type of curve starts to happen, this can potentially be the mark of the end of the point where we're at. So in no way, shape, or form am I telling you that COVID is going to leave. COVID is here to stay. However, this is sort of a signal that can kind of hint towards the end of the term that we've been using as a pandemic. So just looking forward from here, we have a couple key reports coming in these next couple weeks, as well as the start of Q1 earnings. So this is going to be big in terms of telling us where the market is going to go and what direction we're going to pick, because people want to see how these companies are going to perform and if they meet our expectations or not. However, regardless of what we get, we can really move in either direction simply because investors just have a lot on their plates right now. Overall, when you're looking at the big picture, markets are going to move, and if you're positioned correctly, you're going to be able to make a profit and be successful. So let's just go ahead and get started and take a look at SPY here, so that way we can see and gauge where we are as an overall market. So you guys know we look at SPY here. SPY is the ETF for the S&P 500, and this is just going to give you a gauge for the overall market, what the overall market is doing. So looking at the past week or so, you can see that we fell below some pretty significant moving averages here to 10-20, and we came down to the 50-day moving average, which is this yellow line here, and we attempted to bounce up, which we sort of did, and we used the 20-day moving average as a resistance line. So we have a trading range here between the 50-day moving average acting as a support and the 20-day moving average acting as a resistance. Today, markets broke below this 50-day moving average and continued to move down towards our next major support of the 100-day moving average. Looking back, you can see that the 100-day moving average is sort of a point where we usually bounce. So this is a very good loading zone for investors. Investors sort of use this for the entire buy the dip mentality right around this 100-day moving average. So this is what we were paying attention to today. We wanted to see markets come down and use this as a support point at which we bounce from. And we surely did bounce. You could see the volume is pretty strong and we had a very strong close today, pushing us just right above this 50-day moving average line. So now we are back in this trading range that we were in earlier last week. So again, just looking back, you could see that whenever we come down to this 100-day moving average line, what was this back here? Back in October, you could see we hit the 100-day moving average and then we continue to rally up and hit new highs. And we've consistently done this right around the 100-day moving average. So something to note when you're looking at all of this is you have to look at the left side of the chart. And what I mean by that is that you have to look back and see where we are. So when we have a drop like this, a lot of people typically overreact and start panicking and fear that a crash is coming. But when you look at the left side of the chart, you can see that this drop we had, even this drop here that we had back in October of 2021, is not anything significant when you're looking at the long-term picture. March 2020, when the market fell because of the COVID-19 pandemic, you can see we've recovered and we have had a massive rally ever since that point pre-pandemic. So we are trading well above where we were. At the start of the pandemic, SPY was trading at $335 and SPY is currently at $465. That is just an incredible increase. And when you're looking at the left side here, you can see that any drop we really have is not anything significant and that we should not be worried about it. And something else to note is that we know around every 2 years or so, markets can typically see around a 10% correction. So that is not very unlikely that we do see that this year and that we start to come down. So now, you look at something, let's say like Apple, and you can see that Apple has had a very similar trend to that of SPY, a very strong uptrend. We mentioned tech had an incredible year. Actually, we've been bullish for the past 2 years if you really look at it. And it's not going to be unlikely if we start seeing these pullbacks in the tech sector happen. And we could see Apple actually come down to that, 145, 150 range to kind of give us a pullback so that way people can establish positions again. So like we said, this market cycle has to come to somewhat of a slowdown eventually, and capital is going to come out of it. So recently we've seen bond yields, they started to rise. So what does this do? This puts pressure on the tech sector because there's now another place to put your money in, to invest your money into. And we saw the money flow out of QQQ, the tech index, and a lot of these tech stocks. And this only leads to more money being put into other areas that are typically lacking behind. And these areas that lagged last year are mostly financials. So if you look at Bank of America, let's take a look at the 1 year. So you could see that when you're looking at Bank of America, you could see it still has a strong trend, but it is not straight up like tech was. You could see we hit a high and then it started to come down and correct a little bit right around the 100-day moving average where it established support and traded at for a little bit before it started to come back up. Looking back at something like Apple again, you could see Apple is much stronger and has had a much stronger rally since that crash in 2020, and you're going to see money cycle out of stocks like this and into other stocks that are underperforming. So another example with that would be Boeing. You could see Boeing has not had any of that upside potential. They've actually been downtrending very slowly, but they have been downtrending as leisure and travel stocks have just taken a hit since the pandemic. And if you look where we were at with Boeing before the pandemic, you could see we are trading way below the pre-pandemic levels. Once they hit and fell down, they never really recovered to those pre-pandemic levels yet to see those massive breakouts and rallies. So now we're going to start seeing some money from the tech sector start flowing into some names like this.